I think it's the same thing that makes most sense practically all of the time, and that is to consistently buy an S&P 500 low-cost index fund, keep buying it through thick and thin, and especially through thin.
The S&P 500 always beats the rest of the world. Investing outside the United States is just leaving returns on the table. American companies are already global, so why bother diversifying? Investors have been arguing about this for decades. So today, we're going to put the S&P 500 and the global index head-to-head to find out which one deserves your money. On the left side, the S&P 500, the index most people buy through a fund like VOO, created by Standard & Poor's in 1957, made up of 500 US companies. It's the historic benchmark of the US market, covering about 80% of the country's total market value. Its top 10 holdings alone are now over 40% of the entire index. On the right side, VT, one fund that holds over 10,000 companies across developed and emerging markets, capturing roughly 98% of the entire investable world. But here's the first surprise. VT isn't as international as you'd think. It's about 65% US. When you buy every country on Earth, 2/3 of your money still lands in the United States. So who actually performs better? Over the last couple of decades, the S&P 500 has compounded at roughly 10.6% a year, with dividends reinvested. VT at about 8.5%. 2 points of difference. Sounds small, but over decades, 2 points are the difference between comfortable and wealthy. That's compounding doing its thing. In the last 40 years, the S&P 500 compounded at 9.87% a year, and European stocks at 9.88%. There was no US advantage at all. Then look at what investors now call the lost decade. From 2000 to 2009, the S&P 500 returned negative 0.95% a year for 10 straight years with dividends reinvested. And during that exact stretch, international stocks, emerging markets, and small caps all made money. An American investor who put everything in the S&P 500 in 2000 waited roughly 13 years to get back to even. So where did the US advantage come from? After 2009, the S&P 500 has compounded at about 14.8% a year, far above its own historical average, powered by a handful of US tech giants. And just to prove the pendulum still swings, in 2025, International beat the US. The all-country world index outside the US returned 29.2% versus 16.4% for the S&P 500. For a US investor, after the dollar fell, that international return was closer to 33%. So who wins this round? The S&P 500 does. The raw long-run number is higher, but it wins with an asterisk the size of a decade. Fees are the one thing in investing you control completely. So who's cheaper? The flagship S&P 500 funds are almost free. VOO charges 0.03% a year. Fidelity's version, FXAIX, is even less, 0.015%. That's $1.50 per $10,000 invested. VT costs about 0.06%, roughly double. But look at what double actually means here. On $10,000, you're comparing $3 a year to $6 a year. Both are effectively free by any historical standard. Now, over 30 years with compounding, a few basis points do add up. But let's be honest about the size of it. This is the smallest gap in the entire fight. Round 2. S&P 500. Cheaper, technically. But if you're picking your index on a $3 difference, you're solving the wrong problem. As of the end of 2025, the S&P 500 has 40.7% of its entire weight in just 10 companies, a record. Nvidia, Apple, Microsoft, Amazon, Alphabet, Meta, Broadcom, mostly the same handful of tech giants. 10 years ago, that number was about 20%. It has doubled. When those companies fly, the index flies. That's exactly why the last 15 years look so good. But here's the number that should make you pause. Those 10 companies are about 41% of the index's value, while producing only about 32% of its earnings. There's a 9-point gap between what they're worth and what they actually make. VT's top 10? About 22%, half the concentration. But be careful here, because this is where people fool themselves. Buying VT does not get you away from those giants. Nvidia, Apple, and Microsoft are still your biggest holdings in VT too. The 10 largest companies on the planet are almost all US-based. VT dilutes the megacaps. It doesn't remove them. Still, half the concentration is half the concentration. Round 3. VT. Now, the argument you hear most: why diversify internationally when American companies already sell everywhere? And honestly, there's real weight to it. About 41% of S&P 500 revenue comes from outside the United States. Apple earns roughly 64% of its money abroad. Microsoft, about half. Coca-Cola is a US company that exists in nearly every country on Earth. So yes, when you buy the S&P 500, you are capturing global growth, just through US headquartered companies. But here's the counterpoint, and it's the one that decides the round. Foreign revenue is not the same as foreign diversification. If it were, US and international stocks would move together, and they don't always. They trade at different valuations, in different currencies, with different sector mixes and different governments. That's exactly why they split apart in the last decade and again in 2025. Both indexes profit from globalization, one through revenue, the other through revenue and structure. Round 4, a draw. Both arguments are true at the same time. Which one holds up better when everything falls apart? On paper, the diversified fund should cushion the blow. In practice, the correlation between the S&P 500 and global developed markets is about 0.96, almost perfect. When one goes up, the other goes up. When one crashes, the other crashes too. Take 2008. The subprime crisis was a 100% US problem, and yet global markets collapsed together. In fact, world indexes fell more than the S&P 500 did. Correlations, which normally sit around 0.35, jumped above 0.80 the moment it mattered. Read that carefully, because it's the most misunderstood thing in this entire debate. Global diversification does not protect you from a crash. In a real panic, everything sells off together. If you want crash protection, that comes from bonds and cash, not from owning European stocks instead of US ones. What global diversification does protect you from is something slower and quieter, a decade where your one country simply underperforms. So this round is close to a draw, but the marginal advantage is real. Round 5. VT narrowly. Now, the round that actually matters. Because whichever fund you choose, you're making a bet about the next 30 years. Choose the S&P 500 and you're betting that American dominance continues, that its companies keep innovating, that it keeps winning the AI race, that the most valuable businesses on Earth keep being American ones. That's not a crazy bet. It's been the right one for most of the last century. Choose VT and you're admitting something harder, because here's the uncomfortable historical fact. No country has ever dominated forever. In 1900, the United Kingdom was about 25% of the entire world's stock market. The obvious choice. The empire the sun never set on. Today, the UK is roughly 4%. In 1989, Japan looked unstoppable. 32 of the 50 largest companies on the planet were Japanese. Buying anything else looked foolish. Then the bubble burst, and the Nikkei, Japan's flagship index, peaked in December 1989 and did not reach that high again until February 2024. A Japanese investor who bought the obvious winner at the top waited 3.5 decades just to break even. Today, only one Japanese company remains in the world's 50 largest. And where does the US stand right now? It's roughly 65% of global market value, a historically extreme share. Nobody knows if that's a peak or a plateau. Round 6. A draw. Because it's not a fact, it's a philosophy. Two honest bets. Only the future settles it. One last round, and it's the one that's changed most recently. What are you paying for each? There's a valuation measure called the CAPE ratio, essentially how expensive a market is relative to a decade of its earnings. Right now, the US CAPE is around 40. In the 155-year history of that measure, it has only crossed 40 one other time, the dot-com peak in 1999. Europe, meanwhile, sits around 22, the UK around 20. So the US isn't just winning, the US is expensive. And that's why so many major firms now forecast the opposite of the last 15 years. Vanguard projects US equities at roughly 4 to 5% a year over the next decade, with international slightly ahead. GMO goes much further, forecasting negative real returns for US large caps and strongly positive returns abroad. Even Robert Shiller, the Nobel laureate who invented the CAPE ratio, projects around 8% a year for European stocks. Round 7. VT. The fight's over. Let's count the rounds. The S&P 500 takes performance and fees. VT takes concentration, crisis protection, and valuation. And 2 rounds, already global, and which future are draws. So the official result is what it was always going to be, a technical draw. I can't tell you which index is right for you, but I can help you ask the right question. And it's a single question. Do you believe the United States will keep dominating the global economy for the next 30 years? If your answer is a confident yes, then the S&P 500 makes sense, and it would be illogical to give up returns just to hold Japanese and French companies you don't believe in. But if you hesitate, even slightly, then VT deserves a look. Because in 1900, going all in on Britain seemed obvious. In 1989, going all in on Japan seemed obvious. And in hindsight, those were the worst possible moments to make that bet. Buying VT is admitting you don't know who wins next, so you own all of them. And when the center of economic gravity shifts, the fund rebalances itself automatically. You never have to be right about which country. Here's what I actually want you to take away. You're choosing between two genuinely good options. Both are diversified, both are nearly free, both have produced extraordinary returns historically, though nothing guarantees they repeat it. And holding both doesn't really help you, because VT already contains the S&P 500. You'd just be buying America twice. So pick one. Then do the part that actually builds wealth. Invest every single month and don't stop. Your monthly habit will matter far more than this decision ever will. If you want the roadmap for actually starting, I broke down exactly how to invest your first $10,000 and the safest path to your first $100,000. They're both right here. And I'm genuinely curious. Which one are you? S&P 500 or VT? Tell me in the comments and tell me why.